Hey, welcome back to the Road to Retirement. My name's Chris Anselmo here with Tony Marlette from our office and our co-host Tony Shore. And we haven't done this in a while. At least I haven't done it in a while because it's been crazy tax season. So how's everybody doing?
Doing well. Thanks for having us. So we're even going to try to record this one today.
Yeah, for our listeners, we did one probably a month ago. And we had a really great show, and I forgot to hit the record button. So I think we got the record button going now. So. Tony Shore, Mr. Shore, Dr. Shore, how you been?
I have been great, Chris. Doing good. Had a busy couple of weeks. Actually, since we did our last show together, my son got married.
Wow.
And we had a big birthday celebration for him. It was his birthday a couple weeks after that, and the entire family and their significant others got together, and we were all together at once a couple of times in the past month, which is great. You know, once your kids go off to college, that doesn't happen as often. So that was fun. So I've been keeping busy with work. How about you guys? Tony, how have you been? What's going on over there?
Tony survived tax season.
Yeah, I got quite the education during tax season, for better or for worse. Don't tell Chris this. I actually did learn quite a bit. I don't want this to become a thing. You know, he has me doing new things, and I actually learned something and benefit from it. I don't want that. So.
Yeah, it was funny. After day one of tax season, Tony goes, "Well, it's been nice knowing you. Have a nice life. We'll see you."
Yeah,
he was out.
So tax season, tax season's kind of crazy for us because we do about 3,000 returns in 10 weeks, and there's only maybe 5 of us doing them. So you figure that's 500-600 returns a piece. So it gets pretty hairy. So, we're still trying to keep up with everything else we do for clients, the investment sides, the insurance sides, and also the estate planning side. So it does get quite long hours during that time. But now the tax season's over, we thought we'd talk a little bit about what's going on in the market. And Tony's been attuned to that. He's been doing some updates. Rates are going up a little bit. And so what have you been hearing, Mr. Marlette?
Yeah, just yesterday, as you guys are aware, we saw a half a basis, 50 basis points or a half a percentage rate increase by the Fed, which will take most interest rates between 0.75 and 1%. This is more than just, raising rates on loans and on savings. It has quite a ripple effect on pretty much everything. So when you think about home buying, investing in the market, bond interest rates, these yields, these are all affected by rising rates. And contrary to the way it may seem, not all of it is positive. The main reason they do this, first of all, rates were at record lows for a very long time, especially coming out of the pandemic. And then second of all, we have inflation at 40-year highs. When interest rates are raised, that usually calms the effects of inflation. So that's why they stepped in and did it that way this time.
And we've been warning people for years about rates going up and the risk that bonds would hold if you had long-term bonds and you're stuck in a low interest rate and the rates go up and your bond values are going to go down. So for the last several years, we've been using indexed annuities as a bond substitute. Try to get, maybe 2, 3, 4, 5, 6% interest without any market risk. So that, and we noticed the insurance carriers have raised rates, right?
Yep. Yes, they have. So they raise rates, and you bring up a good point. When stocks are volatile, historically, people have retreated and gone into bonds. Bonds have not provided any relief.
No.
Even the yields and the income that they generate are not enough to make up for the drop that we've seen in the last 12 months and year to date. So that's a good point about offering people protection. Kind of the whole 60-40, 70-30 portfolio is looking a little bit different these days.
Well, yeah, it used to be people would have all their money in stocks and bonds. And so they did the 60% growth, 40% in the safety of bonds, but bonds haven't been good in a while, and they're really not good now that the Fed
the
just raised those interest rates.
And the alternatives weren't good either, because they, the other safe haven was go throw it in a bank, and the bank spent nothing, literally nothing.
Yeah, exactly. But bonds, they're a bit down because interest rates are rising.
Right.
And then market volatility, guys, it's crazy. I hope you didn't have all your money in Netflix. Let's just put it that way. It was down about almost 70% at one point.
Yeah, I mean, the
time to buy in, right?
Well, that's right. That's exactly it. And I think it does create opportunity because, as we've been saying, nothing is, with a lot of these companies, nothing is fundamentally wrong with any of them. Yes, I know we're coming out of the pandemic. People are not streaming as much. It's not like Netflix is going the way of Blockbuster today. It's not like they're going out of business and it's going to be an afterthought. So
they do have a lot of competition now. There's a lot more streaming services.
That's part of it. There's a lot of factors when you drop 70%. There's got to be a lot of factors. But again, the talking heads say stay the course or buy in. You got to buy low and sell high. That's the key, and almost no one does that because we all use our emotions, right?
And that's one reason we hire Gradient as money managers. I mean, they're looking at this 24/7 every day of the week, and our job really is to be with the client. Right. So we can't keep the same focus on the market as someone who's doing it 24/7's got the 5 screens going on at there. So that's why we hire that company. And that's why, look, you got to pay them. You want quality, you got to pay for it.
And they're, to that point, one of their portfolios, I talked earlier about how bond yields are not keeping up with bond prices. They're not having a positive offset. Gradient has a yield portfolio that's made up of not just bonds, but a large cap dividend paying stocks, real estate investments, preferred stocks, that the yield actually is outweighing the negative market volatility for the year. So the yield is about 6%. The performance for the year is about 6%. Not that you ever really want to break even, but
past performance is no indication of future results. No.
Correct.
Well, right. And you guys aren't, we're taking a broad view because everybody's situation is different. So you're not giving any specific advice until you get a chance to look at somebody's situation, run some reports, and see where they're at. But I think it is important to note what's going on. And it just stresses the importance of working with folks like you, Tony and Chris, because it is so important to work with a trusted financial services professional during these times. I think the people that get hurt, especially now, are people who don't have a solid plan in place, or a financial services professional, or those DIYers, that have been trying to do it themselves. When the market's this volatile, it doesn't work.
Well, and I tell clients, when the market's going gangbusters, I don't want to say you don't need us, but that you need us less during when the market's going having gangbusters. But when the market's very volatile and they're raising interest rates and bond rates are changing, and in the bank, that's when you need to hire a professional to do it. And it's like anything else in your life, you got to pay, right? So and it's not expensive. I have this saying, we've been talking about. I don't know if we've shared it on our show, and I got this from a friend of mine many, many, many moons ago. Owned a little print shop. He had a little thing right by his cash register, and it said quality, price, and service. Pick 2 of the 3. And you kind of laugh, and you're like, "What do you mean 2 to 3?" He goes, "You can only get 2 of the 3. You can never have all of them. Right? You can't have Ritz-Carlton service and expect to pay Red Roof Inn prices. So which 2 to 3 do you want? Do you want to be the cheapest on the block? If you want the highest quality and the cheapest price, then you got to do it yourself, because you don't want to pay for the service. But then again, you could have the greatest service and the greatest price, but sleep in a bed that's got bed bugs, right? So you, at the end of the day, you really want quality and service. So that's what we try to strive at. Now we're very competitive. We're not going to be the cheapest on the block. We're not the most expensive, but we're competitive. So if price is the only thing you're looking at, I think you're just missing. Otherwise, everyone would buy the cheapest car out there, right?
Yeah, and one thing just to add on to that, I mean, when I had this conversation with somebody yesterday, when you come here, I've worked at other places where we have to we have to refer out a CPA. We have to refer out an estate planner. I can handle the financial stuff, but you got to talk to your tax advisor. You got to talk to your estate planning attorney. We handle all that in-house. So if time is money, which a lot of people believe that it is, you get everything all within one within one roof, under one roof.
And it's important because the left hand really does know what the right hand's doing. And we've seen so many mistakes over the years. And they're not really mistakes. Maybe it's just been overlooked. I mean, we have estates that come through our office $2-3 million, and no one's ever took the time to do a trust or anything, and ends up in probate, and they spend $50,000, $60,000, $70,000 in fees in probate. And they're like, it's because you didn't take the time to do it. And we have everything here. Just eventually you got we have that little chart we go through, Tony, and eventually you got to get all this done. So we did your tax return, we did this, we did that, but you got a whole other side of your life you got to get accomplished. So I think that's one good thing about working with a firm. I don't want to tout our own horn, but
well, that's another good point. That people are like, I don't want to spend any money on an estate planning attorney. We'll just download some forms and do it ourselves. And it ends up costing them tens of thousands of dollars later down the road. It doesn't make any sense.
And we do a lot of elder care planning, which is the planning for nursing homes and how do you try and protect some of the money. And, people are like, I'll just give it to my kids. I'm like, well, what if your kid gets divorced? Right? What if your kid kicks you? And we've had, not in our office, but we had stories where, you give the house to the son, and the daughter-in-law makes the son kick the mom out of the house. I mean, so there's ways of doing it. There's ways to do it properly. So, you spent years and years, your lifetime acquiring this wealth. Don't get penny wise and pound foolish at the end. So. And statistically, it's not good. So we have stats here in our area right now. It's running about $10,000 a month to be in a nursing home, maybe even 12. So that's very expensive, very fast. And there's things we could do to help protect. And the misconception is that the nursing homes take things. They're like, well, they're going to take my house. They're going to take my car. They don't take anything. They sent here's the bill for here's the bill for your mom for May. It's $10,000. Please pay the bill or take your mom home. Here's the bill for June. It's $10,000. They're not in the business of owning real estate and other things. They send you the bill for the month. You either pay it or leave. So
you have to find a way to pay it. That's where the house goes.
So we want to do it efficiently, and if we can position some assets, and maybe we can, at the end of the day, we can get the government to help pay for this, because it's just such a huge bill that nobody thought about. And when we wrote that book, Tony, I don't know if you remember, we wrote this book called Hindsight. So Hindsight, we sent out, it's a short book. It's maybe only 100 pages long, if that. We sent out about 1,600 questionnaires to our clients and said, hey, if you were 15 years away from retirement, what would you tell people to do? If you were 10 years away, 5 years away, now that you're retired, what would you tell the next generation? And some of the biggest things were healthcare. We didn't expect healthcare to cost this much, right? We planned that we'd have Social Security in our retirement, but we didn't expect to pay, $500, $600, $700 a month for healthcare. So that's a big one. And the cost of nursing homes, they have one parent or someone in your family go through it, and they're like, wow, they just spent $300,000 that they never thought they would have to spend. And it's okay if you're single, go ahead, spend it all. But if you have a spouse at home or significant other at home and you just spend all the money and they got 20 more, 30 more years to live, we got issues, right? So so that's one benefit of working with our firm, that we kind of look at everything. So Tony, what else going on in the market? Anything you see?
Well, obviously we still have the effects of inflation. That's really not going anywhere. Year to date, bonds had their worst quarter in 20 years. The market's down. We expected this, though. We expected volatility. As you guys were mentioning earlier, both of you, it's not the time to panic. You want to stick to the scope of your plan, work with your financial professional, like you guys were each mentioning. And you shouldn't be investing for things that are going on now. You need to be investing for your goals and your time frame, not for what's going on now. I don't have any problem with some side cash if people want to play around and kind of do some trading and do
So
some things like that for
golfing
now.
money.
Yeah, some golf
Golfing
money.
money.
So, Mr. Short, you've talked to a lot of other advisors like us. What's the word? Is it pretty much? I know this is one reason we use money managers. So they will watch the money, they will make the moves. Is that what you're hearing too?
Yeah, and I mean, just talked with Mike Binger, the president of Gradient Investments, and of course, his advice is stay the course. I think most of the talking heads and the advisors I hear from out there, the market is down overall year to date about 10 to 12%, and I think they foresee a lot more volatility, and that's kind of what they've been talking about. But for most people, staying the course is a good course of action, but making sure they're working with a good company that has your funds actively managed. Don't just throw it in a 401k, select medium risk to low risk and think it's going to be great. It depends on, of course, the time horizon. And everybody's talking about what you guys are talking about. I mean, because there's market volatility and low bond rates, you have to look at other tools and options, and there are other vehicles out there for that money that you're going to need. And it's different for the advice is different, obviously, for people who are very near or in retirement versus somebody who's a young pup. Like, I'm not going to name names, Tony Marlette, but
I may not be as young as you might think. I know
you're younger than us.
You're younger than us. Let's just put it that way. You've got a junior behind your name for a reason.
Fair enough.
But seriously, I mean, if you're 35 and you don't just stay this shouldn't even bother you. You just stay the course.
Yeah.
But if you're 65, you better be in a seat talking to Chris Anselmo and Tony Marlette at this point.
That's one reason. One reason I really like our Tilt series. The Tilt series is let's call it a model that allows the money managers to move money around in various scenarios when they see the timing is right. So instead of just sticking with one portfolio, they can move it in and out of portfolios. If they see an opportunity here, or they see they need to retract something in another portfolio, they can move it around. So the Tilt series has really been a godsend to being able to let the money managers do their job, because before, we would have to go in, okay, let's move it out of XYZ portfolio and put it in an ABC portfolio. And we don't really like to do market timing because it doesn't really work. So it's really kind of neat that I think the Tilt is made up of maybe half a dozen or 10 different portfolios, and they can move in and out when they see fit. So I think that's really good portfolio.
Sure, there's a lot of things like that. The Tilt and the buffered index portfolios, and so there are a lot of things that you guys have your clients in. So when this market volatility comes along, they can still sleep well at night. Yeah. But for our listeners out there that haven't had a second opinion, or viewers in a while, or talk to a financial services professional, I don't care if you've got $50,000 in a 401k or $5 million in a 401k, you've got or an IRA.
I was going to say 50 million.
50 million. I know you guys work with the gamut. You've got to be talking to a financial services professional. I mean, it's just
even if it just reassures yourself what you're doing is okay. Sometimes
just get a second opinion on what you're doing. Right.
So sometimes we have a second opinion, and it's not often that we get it like, wow, you're perfect, but oftentimes they are pretty good along the way. Maybe we just need to tweak a couple things. So it doesn't cost clients. Like, we don't charge to do second opinions because we don't even know if we can help you. If we can't help you, we don't want to charge you. So, but oftentimes maybe you have 80% of the stuff right. You just need to work on the 20%, or vice versa. You're a mess and we need to fix it. And it's not that people intentionally screwed up, or I don't know, that's probably the wrong word, but life just happened. You were investing at Tony's age, and now 20 or 30 years later, you're at our age, and your portfolio, you never change your portfolio, right? So you're still investing like a 35-year-old, 40-year-old when you're 65 and 70, and that's probably not the right parameter. So it's good just to sit down, and oftentimes people don't know that they are investing like that. They're like, wow, my guy told me everything was safe. I'm like, You have 98% of your money in the stock market. How can it be
That is a
completely
very common misconception. That's a great point. I saw people during tax season who said, I'm relatively conservative. We ask for a statement. They bring in a statement and they're 85% in the market. It's just not,
Wow.
it's not accurate. So
Yeah.
it's been a while since you've looked at it. Diversification will help reduce your risk. So maybe that's what they're thinking, but still being 85% in the market is not conservative.
And I think part of that is
Approach.
they're going to advisors who are one-trick ponies. They're either going to a guy who just does insurance, so he's going to talk bad about the market, or he goes to a person that just does market stuff, and they're going to talk bad about insurance. It's like going to the Ford dealer and say, "How do you like those Chevys?" Chevys, So here, when we can do everything, then there's no hidden agenda. I mean, we don't pick what you should do based on how much we get paid, because we're fiduciaries, and on the fiduciary side, that means that we don't make commissions. So anything that we have managed money in the market, we're just making a percentage. So ahead of time what you're going to pay. So there's no incentive to buy the purple one because it pays better than the red one, right? So where if you go to places that don't offer insurance products or don't offer securities, I always tell people it's like going to the dinner party and you were told to bring the fruit salad, and Tony, you went to the apple orchard and you said, "Hey, I need pineapples." He goes, "We got red, green, or yellow apples." I need some cherries. We have red, green, or yellow apples. I need plums. We have red, green, or yellow apples. You're getting red, green, or yellow apples, even though you need a whole fruit salad. So, so it's really important to make sure you're working with the right type of professional. We're not the only ones out there that like us, but there's not many firms that do, at least in our area, that do everything, right? So,
right, there are not many. I talk to people all across the country, and you have a unique situation there. The people that live in your area are fortunate, because very seldom can you walk in a door and talk to an estate planning attorney, a tax professional, and a certified financial professional or planner, and get all that advice under one roof, and with the experience that you offer. But if you're going to work with a financial services professional, make sure they're, number one, independent. Don't work with one of the national chains where it's walk in a strip mall and they have a set thing, and they don't look across the board at all the possibilities, and don't work with just a broker or just an insurance salesman, like you said. I think it's key. Well, to wrap it up, why don't we let our listeners know how you guys are offering a no-charge consultation, right? They can come in and sit down with you. There's no obligation. Get a second opinion, right?
Yeah, Tony's got all that stuff up there on the board there. So
excellent.
Just call our office or go to our website. I think you could even set an appointment through our website, right, Tony?
You can, yes.
So.
Absolutely. One last question I have. Are we considered talking heads?
At this point, we are. Looking at the screen, and maybe not even the most attractive talking.
I think Tony, you got your little Devo hat? Do you have that?
I have a Devo hat. It's on the other side. It's literally right over there. So
okay, guys. Well, it was a great show. Again, if you want to get a hold of us, 440-886-3550, or look at our website, brooksidetax.com. I'll look forward to seeing you guys at our office. And Tony, we'll look forward to the next little podcast. I almost called it a webinar, but it's a podcast. So,
all right. Thank you, gentlemen.
Okay. See ya.
Thanks, guys.
See you later.
See ya.